The UK government recently published its consultation and call for evidence paper on the future financial services regulatory regime for crypto assets. In that paper, the UK government set out its ambition to be a world leader in fintech. It believes it can achieve this goal, unlocking growth and boosting innovation by taking advantage of the huge potential benefits of crypto technologies. The benefits are real. Crypto assets have emerged as a new asset class for investment for individuals and institutions, and the underlying technology has the potential to disrupt various parts of traditional finance, from lending and asset management through to insurance. But as an emerging technology, crypto assets can bring significant risks. Crypto markets are turbulent, and the collapse of the major crypto exchange FTX has sent shockwaves through the industry. In order to promote the benefits of crypto technologies, whilst giving businesses and people the confidence to invest with an understanding of the risks, the UK government has outlined in the consultation and call for evidence paper its plans for a more comprehensive financial services regulatory regime for crypto assets. This, it says, will help promote more transparency, increase consumer and investor protections, and instill greater governance and risk management rigor within crypto businesses. This video describes at a high level the current regulatory regime, the key takeaways of the paper, and some thoughts for the future of crypto asset regulation. The UK government's proposed regulatory regime will relate to regulating crypto assets within the financial services, as opposed to aiming to regulate the wider application of distributed ledger tech in the financial services or the use of crypto assets outside the financial services. The foundations for this framework have already begun to be built. For example, an anti-money laundering regime for crypto assets has been in place since 2020. This requires crypto asset exchange providers and custodian wallet service providers in the UK to be registered and comply with money laundering regulations. The government will shortly introduce legislation to require the regulation of promotions of certain crypto assets by the FCA to ensure they're clear, fair, and not misleading. The government is also currently legislating in the Financial Services and Markets Bill 2022 to introduce a regime that will allow for the regulation of fiat-backed stablecoins used for payments, which the paper refers to as Phase 1. The consultation paper sets out the next phase in its regulatory journey, Phase 2. So, what are the key takeaways?
It's helpful to understand how the government is aiming to approach the potential regulation of the crypto asset sector. The design principles for a new framework for crypto assets is for it to be proportionate and focused, agile and flexible. Regulation will be consistent with the future framework regulatory regime, which will be established by the upcoming Financial Markets and Services Bill, and the government hopes that by providing further powers to the FCA and the PRA, these regulators will be better positioned with new regulatory powers to adapt to changes in the market and international standards more readily. The principle of same risk, same regulatory outcome is a predominant theme behind many of the proposals in the consultation. The government intends to regulate financial services activities rather than the specific crypto assets themselves, although there may be cases where the entities pose or are likely to pose systemic risk, and this may warrant further regulation under a different regime. Fiat-backed stablecoins will fall within the Phase 1 proposal, but the existing proposal by the government, subject to feedback, is that most types of other crypto assets, both fungible and non-fungible, will fall within Phase 2 if a relevant regulated activity is carried out in respect of that crypto asset. This concept of a regulated activity is based on the existing regulatory perimeter in the UK, which evaluates whether there is a specified activity being carried out in relation to a specified investment. It appears that the government will build a list of specified activities in relation to a broad range of crypto assets. It's likely that there will be significant feedback on the current broad definition of crypto assets, which appears to cover both fungible and non-fungible crypto assets, including utility tokens. The types of regulated activities in relation to crypto assets broadly align with many existing regulated activities, for example, in relation to arranging, such as exchange activities, and also dealing, advising, and managing. Another material area of feedback is likely to be on the question of whether the activity is deemed to take place in the UK and so require a UK authorisation. The government is proposing that regulated activities will have extraterritorial effect in that it will cover activities in the UK or to the UK. The government is also shortly introducing legislation which regulates the financial promotion of certain qualifying crypto assets, largely understood to be fungible crypto assets, although this definition is still to be well defined. Financial promotions in relation to fungible crypto assets will either need to be issued by an authorised person or approved by an authorised person, unless an exemption is available. There is also a third category that has been added, which was introduced as a concept by the government most recently on the 1st of February, which enables a crypto asset business registered under the UK money laundering regulations to communicate their own financial promotions in relation to qualifying crypto assets. The government is also conferring powers on the FCA to enable it to provide guidance on the qualifying crypto assets definition and make rules in relation to financial promotions. In the FCA's public statement on the 6th of February, the FCA warned that crypto asset firms must get ready, and that includes firms based overseas. The government is seeking to introduce this financial promotion legislation in the next 4 to 6 months, and so firms should start considering their regulatory position now.
The UK is already behind the curve compared with other regions. For example, the EU is well advanced in agreeing the terms of its markets in crypto assets regulation. However, the consultation is far-reaching in its approach to regulating crypto assets. In addition, it marks the next phase, but not the final phase of this journey. A lot more is on the agenda. For example, in its call for evidence, other key areas of interest for regulation include decentralized finance and mining activities. Given the sheer scale of the potential regulatory framework, it is imperative that stakeholders in the blockchain industry take the time to comment to help shape the future of regulation. The consultation will close on the 30th of April 2023, so there is time. We're keeping on top of regulatory developments both in the UK and in Europe, so please get in touch if you have any questions. Thank you.